So one of the best investors of all time is a man named Peter Lynch. He ran Magellan Fund for a large chunk of the entire 80s, part of the 70s and 90s. He has a story he tells. It's called the cocktail party story. And what he's trying to determine in this is where the market is at any given time. He says if he goes to a cocktail party, he's talking to everyday people that he deals with. If they ask him what he does for a living, and he says, I work in stocks, and they say, oh, I feel bad for you, he says, that's a time to buy stocks. If he goes to a cocktail party, and the people ask him what he does, and they're kind of indifferent, saying, oh, good for you, probably thinks that stocks are probably somewhere in the middle. If he goes to a cocktail party, and people are giving him stock recommendations, he says, now's the time for me to sell. And the whole point about that is, when the general public has their input on some sort of investment, it usually means that times are too high and euphoric. So in the world of investing, not just real estate, stocks, bonds, commodities, anything you're doing investing, it's a pendulum. And the pendulum swings between euphoria and basically what I call depression, which is super great times and bad times. You're always along the pendulum at some point. The goal is to figure out at what point of the pendulum are you at. If you look at any sort of history of investments, like stocks in 1999, real estate in 07, 08, those were times of complete euphoria. And that's when was the worst time to buy. When everybody feels the best, and when the average person is buying stocks, buying real estate, buying things like Bitcoin, you should avoid those things. That's basically my premise when it comes to any sort of investing. I want to look at where is the average person in that level of investing. After the 07, 08 real estate crash, so many people got wiped out that nobody was buying investment, nobody buying real estate anymore, and we were able to buy real estate at bottom prices. So I always thought to myself, okay, during that time, a house that sold for $120,000 in 06, 07, I was able to buy for $10,000 or $15,000 in 09. 2 or 3 years later, the price would fall by 90%. Why is that? Is that property really worth 90% less? No, of course not. But the difference was that the average person wasn't driving up the price because so many average people were trying to buy in those markets. Does that mean as an average person you can't do well in investing? Not at all. You can do very well in investing as long as you're cognizant of where we stand in the pendulum of euphoria and, for lack of a better word, depression. This isn't just, one of the things that I always talk about is people will say, you're a real estate person, you're a stock person, you're a business. Investing is investing. And that euphoria and depression pendulum swings in all levels of investing. It doesn't matter what it's at. And what we try to teach people is be cognizant of where you are, and it's okay to be patient. It's okay to do nothing. There's a movie, Tin Cup, in which his caddy says to him, par is sometimes good enough to win. You don't always have to hit home runs. You don't always have to have money invested. You can be on the sidelines. If you're on the sidelines making 2 or 3%, that's better than putting your money into an investment that has a chance of losing money. But people always think, we're always taught you have to be doing something. You have to be you're either growing or dying and there's no third direction. That's from Tommy Boy, by the way. And that could be true, but in the investing world, sometimes investing when everybody else is investing is the worst time to invest. Supply and demand. It's the very first thing you learn in economics. The less supply and the more demand of something, the higher the price goes. So think about any sort of investing. Think about stocks nowadays or in 1999. Think about real estate back in 2007. There was immense demand because the average people, not just the experts, the average people were coming in and getting into real estate. So they thought, oh, I'm not going to lose money if I invest. So I'm going to go bid up these prices. With demand increasing and increasing and increasing, what happens with prices? They go up and up and up. When you pay more for something, your returns go down. That's a hard thing for people to understand because they think, well, no, if I pay more for something, the price goes up. Somebody else pays more, the price goes up, and therefore I make more money. Well, theoretically, that's the greater fool theory. The whole point about a piece of real estate is if you buy a piece of real estate that makes $1 and you pay $10 for it, what's your return? 10%. But that same piece of real estate has more demand for it. Doesn't mean that the dollar in profit doesn't go up. It's just the price goes up. All of a sudden that price goes from $10 to $12 and your return goes from 10% down to 8.3%. If it goes to $15 because more people want to buy it, your return goes to 6.6%. As you can tell, you still have the same $1 of profit. The only thing that's changed is the price you paid, and your return goes lower. So in investing, the big key to know is the more you pay for something, the less money you're going to make. The less you pay for something, the more you're going to make. If you paid $8 for that piece of real estate instead of 10, you're going to make 12.5% because that $1 profit is still $1 profit. But people are so attached to the value of their asset as opposed to the return they're getting from the cash flow. And that's where you start to get into problems. Warren Buffett always says, be fearful when others are greedy, and be greedy when others are fearful. It's the same thing as the pendulum swinging. You have so much fear here. When people are scared, that's when prices are low because demand is low. You have so much greed when everybody's euphoric that's when prices are too high and you can't make your return. So you should be fearful then. But we always work as a society in the opposite way. Investing, I always say, is the weirdest thing in the world. It's the only thing in the world that people want to pay more money for. Everything else in the world, everybody's like, oh, I got a great deal. I bought a car, I got a great deal. Oh, I bought a shirt, I got a great deal. I bought it on sale. But real estate, oh, now's a great time to buy real estate. Why? Because prices are going up. Well, that doesn't make any sense. That's how we think as society. We're all lemmings. We all want to follow. Does that mean it's always going to be that way? No, there are a few group of people in history, Warren Buffett, Howard Marks, Benjamin Graham, Charlie Munger. These are the value investors of our time and the past, the father of value investing, who've shown that if you're just able to be patient and wait for the right time to buy, you will beat the others. You will beat everybody over the long haul. Now, are you going to miss out on good deals as prices get higher and higher and higher? Sure, of course you'll miss out on good deals. But those good deals happen because the market got better, not because your investment got better. In real estate, you have to manage the property to make it good, but you also have to buy the property right. The analogy I always give with any students I work with is the iPhone analogy. So I've got an iPhone. It's a pretty phone. This is the iPhone 8, not the iPhone 10. But I always tell people, I always sit in a class and say, what's the best phone out there? And invariably, I always hear the iPhone. Okay, the iPhone. Would you buy this iPhone for $1? Of course I'd buy it for $1. Would you buy it for $2? Of course. What about $20,000? Well, no, I'd never buy it for $20,000. Why not? It's the greatest phone out there. There's always a price to be paid for everything. Just like a piece of real estate. They always say location, location, location. Well, that's important, but it's really price, 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 and value, value, value. I could have the best location in the world. If I have the best location in the world and the property makes $1 million a year, paying $1 billion for it will cause me to lose money. I will not do well. And having the worst location in the world, but if the property makes $100,000, but I'm able to buy it for $500,000, I'm going to do very well because I'm making 20% return. So the key is to buy everything the right way. If you pay the right price for any asset, whether it's the best location or worst location, best company, worst company, you can still make a good return. But as a society, we don't look at it that way. We don't analyze. We look at, what are we buying? We're buying a cool company. We're buying a cool piece of real estate. We shouldn't look at it that way. We should look at it as buying revenue and buying profit. And along the euphoric spectrum, if you think that way, you will do best when people are avoiding assets, when they're depressed and think times are bad, because that's when people will avoid, the demand will be lower. You can go buy the assets, the pieces of real estate and the stocks that nobody else wants because they're selling for good prices, even though the asset might be doing well itself. It might be increasing revenue, increasing profit, have stable tenants, etc. The more you pay for something, the less money you will make. For the next minute, I'm going to explain to you our software at everythingmoney.com and how you can use it to retire with more money than you thought possible. Do you get anxious every single time the market dips? Do you feel like maybe you're behind on your savings? Is it ever a worry that you may not have enough money to retire? If you've answered yes to any of these questions, then our software is absolutely perfect for you. With these easy-to-use tools and our community with thousands of other like-minded investors in there, you can use all of this to have better peace of mind and to understand why you are making the decisions you're making, because it's more about the emotion and temperament than it is about the numbers. And these tools, especially this community, will help you realize that and make better decisions going forward. You will absolutely be able to understand financial statements and impress your friends who still waste their money buying stocks based on their emotions and other hype people out there. So for a little over $1 per day, less than a cup of coffee, eliminate that fear from your life of worrying about your future financial state and your retirement savings, and try our software risk-free for 30 days. If you don't like it, email us, money back guarantee, no questions asked. Go to everythingmoney.com, sign up now, and change your financial future starting today.